Thank you for joining me. I'm Alexandra and I want to talk about Visa. So they do credit cards mostly, but it's more of payment processing because the credit cards really get issued by the banks that hold the credit risk. So being the company that does the payment processing is far better than being the company that gives out the credit cards, even though the latter is probably more profitable. Regardless, the payment processing side comes with pretty much no risk. So that's where Visa is, and that's why the stock is one of the most consistent that I've ever seen. Current stock price $219.43, which gives them a market cap of $484 billion. Revenue $21.8 billion. Earnings $10.9 billion, which gives them a PE of 42 with a forward PE of 38. So obviously, if you are a bank and you just have billions of dollars to give out credit to people, then revenue of $20 billion wouldn't be great, but a 50% profit margin is just amazing. I don't think I know a different business that has that kind of profit margin. Dividend yield just under 0.6% with a payout ratio of 25%, which is not great at all. Total assets $80.9 billion, total liabilities $44.7 billion, which gives them a total stockholders' equity of $36.2 billion. And as usual, I really don't like this balance sheet, even though strictly speaking by the numbers, it's pretty nice. Assets to liabilities ratio is almost 2-to-1, which is almost optimal. But $34 billion with a market cap of $484 billion is just not a lot at all. And the other problem that I have with this is that they buy back stock worth $8 billion, and that is in line with the previous year. So in the past 5 years, they bought back more stock than the whole stockholders' equity is right now. I don't like that. I don't think there's a good reason for it. As far as the risk factors go, people stop using credit cards, I guess. I really don't see a whole lot of risk factors here. Even competitors coming into the market, like we now have, well, now is said too much. American Express is older, but we have American Express, MasterCard, Discover. I don't know if Diners Club is still around. What's one more, really? I think that people are more inclined to get another credit card rather than just switching. I really don't think there's many people who close their accounts to switch to a different one. So overall, I don't think there's really any risk factors here. And I think it's amazingly solid, and the stock price just continually keeps going up. It's one of the most consistent I've seen. For a growth investor, obviously, there's currently no growth. Usually they do have quite a bit of growth, but not like growth investor levels. So I would probably pass on that if you're trying to 10x your money over the next 10 years or so. For a dividend investor, I don't think the dividend is quite enough at this price. I don't see them really increasing their dividend a huge amount either, because they do more in stock buybacks than, increasing dividends. So probably just go for better opportunities there as well. And for a value investor, I think the PE is just way too high. I think it's mostly justified by just the consistency that the business has and by the low bond yields that you can now get. So if you wanted to invest in this purely as a value investor, I don't think I would blame you, because it's very consistent, it's very stable, there's continuous growth, and the stock buybacks do kind of sort of help you if you're holding long term. But I do still think that there's better opportunities out there for value investors as well. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.